Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Castor Maritime stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Castor Maritime leases ships to various companies, and those companies use the vessels to transport oil, iron ore, coal, soybeans, etc. Most companies sign an agreement to take possession of the ship for a predetermined period, such as 3 months. Castor charges these companies a flat or floating rate based on the market rates and various other factors. They currently operate 20 dry bulk carriers with a total cargo carrying capacity of 1.7 million deadweight tons and an average age of 12.4 years. They have 7 Aframax with an aggregate cargo capacity of 0.8 million deadweight tons and an average age of 17.7 years. They also have 2 handy-sized tankers that can carry 100,000 deadweight tons with an average age of 16.2 years. The average age of all 29 ships is 14 years. In order to continue trading on the NASDAQ and meet the $1 minimum stock price, the company did a 1-for-10 reverse stock split in May 2021. The company is headquartered in Cyprus and was founded in 2016. The ticker trades on the NASDAQ, Norway OTC, and Deutsche Börse. Let's get started with the model. This is a micro-cap company, 177 million market cap. They're trading at 187 a share, and they have 95 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They still have negative free cash flow each year as they're investing a lot back into their business to grow it. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 2020. It peaked in the trailing 12 months at 71 million. Revenue is the sales for the company, and that grows a lot from 6 million to 180 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grows a lot from 2 million to 87 million. Their gross margins are almost 50% in 2021 and the trailing 12 months. Gross margin is gross profit over revenue. And obviously their margins were really low in 2019 and 2020 because they had such small revenue. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that grows from 1.3 million to 76 million. Their operating margins also look really good, 42% in 2021 and the trailing 12 months. They were only 3.5% in 2020, 22% in 2019. They paid 3.3 million of interest on their debt, which is a lot higher than prior years. Last year was 2.2 million, before that it was 1 million, and before that it was 200,000. They also spent 845,000 in financing costs because they do finance some vessels, and also they take on debt to buy vessels. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which looks really good in the trailing 12 months at over 70 million. This chart is from their most recent quarterly report, and you can see their revenue in the first quarter of 2022 was 55 million. Up from 7 million. So the company's growing at a really fast rate. That's a change of 680%. And their net income is up from 1.1 million to 20 million, a 1700% growth. In order to fund their growth, they did add a lot of stock. They had 58 million shares outstanding in the first quarter of 2021. Now they have 95 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. They spend a lot in CapEx because every time they acquire a vessel, the cost of that vessel goes into CapEx. Then it's carried on the balance sheet and depreciated onto the income statement over its useful life. Operating cash flow minus CapEx gives you your free cash flow, and they have negative free cash flow each year. So they're mainly funding their business with stock. They added $235 million in the trailing 12 months, $362 million in 2021, and $49 million in 2020. Every time a company adds common stock, it increases the shares outstanding and makes your shares less valuable. They added $40 million of debt in the trailing 12 months, paid down $16 million. Let's look at the capital structure. $360 million of equity, $150 million of debt. They're 70% equity, 30% debt. And their net debt is $79 million. I gave them the highest whack on Finbox, 13.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $757 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $348 million. We divide that by 95 million shares. And we get a calculated stock price of $368. They're trading at $187, so they're trading at a 49% discount. It's a buy according to the model. To calculate their future revenue, I just grew at 10% for the next few years. The average company in their industry converts 32% of their revenue into free cash flow, so I multiplied their future revenue estimates for 2025 by 32%. That's how I got $84 million. And I assumed they would have negative free cash flow before that. Here's a chart of the stock price the last 2 years. It looks like it got up to $14 a share. Remember, they did a 1-for-10 reverse stock split. So all the stock prices before this S have to be divided by 10 if you want to know what it was trading on that day. Usually when a company does a reverse stock split, the stock price goes down, because a reverse stock split raises the stock price and it gives short sellers more of an opportunity to short the stock. The company's profits are highly correlated with the shipping rates. The higher the shipping rates, the more money this company makes, and the lower the shipping rates, the less money they make. You can see shipping rates got really high towards the end of 2021. This is the Baltic Dry Index. This shows us the average price paid for the transport of dry bulk materials across more than 20 routes. Here's another index to track to understand the shipping rates. This is the Drewry World Container Index. If you somehow had the foresight to buy the stock down here, then you could have made a ton of money when shipping rates increased. But if you bought the stock at the peak of the shipping rates, you're probably going to lose money. They've only done one stock split. It was in May 2021, a 1-for-10 reverse split. They have a really low beta, 0.22, so the stock moves 1/5 the market. It's gone down 44% in the past 52 weeks, while the S&P is down 3%. The 52-week low is $1, the high is $3.53. And the stock is trading below its 50-day and 200-day moving average. Only a couple million shares are traded each day on this stock. Pretty much all the shares outstanding are on float. 1% are held by institutions and 2% of the shares are shorted. If you invested $10,000 into this company when they started trading, you'd have $370 today. That's a 96% loss. 99% of the company is held by the general public, 1% by institutions, and 0.1% by insiders. Here's a list of the top 10 biggest shareholders. The CEO owns 0.12%. Here's Morgan Stanley, Geode, and Citadel. Let's look at their financial ratios. They have an amazing PE of 2.5, that's stock price over earnings per share. Price to sales of 1.0, a price to book of 0.5, and we can't look at that price to free cash flow since they have negative free cash flow. Their ROIC is 14%. They can cover their interest payments 23 times. They have a high ROE of 20. A current ratio of 2.4, that's current assets over current liabilities, and a quick ratio of 2.2. They lost $214 million of free cash flow in the trailing 12 months, and they have $60 million of working capital, so it looks like they're going to be short. They may need to add some debt or equity over the next 12 months. The best way to look at ratios to compare them to companies in the same industry. There are 34 companies in the same industry as Castor. And if Castor has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend more than average in CapEx. They have a better debt to equity ratio than average. They're one of the few companies on this list that does not pay a dividend. They have negative free cash flow. They rank 25th in market cap out of the 34 companies. They have really good price multiples, a really good price to book, price to earnings, and price to sales. They do generate less revenue than the average company. and they have a high ROA and ROE. So to summarize, I have them trading at a 49% discount. Many people have lost money on this stock. It seems almost pointless to invest in this company, but I know there's lots of people out there that think it could 10, 20, or even 50x. I guess only time will tell. I rank their free cash flows 2 out of 10, their revenue 6 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.